Yeah, welcome friends to my this channel Risk Sutra, where we were covering the entire RBI circular on the draft guidelines for standardized approach. So friends, this is the part 4 of the series, and today we will cover the retail exposures. And friends, if you have not watched my previous video, please I request to go and have a look on that so that you will have a better clarity on what's going to come on April 2027. Right, friends? So without wasting any time, I will straightforward move to section number 14 because till section number 13, I have already covered in my previous video. So friends, today we will cover this regulatory retail exposures, right? The regulatory retail exposures. So I will try to not only give the overview of this circular, but also I will try to give you the practitioner's insight based on my experience and what actually is going to change in the banking based on this. So retail exposures is one of the most important part of this circular, and you must be knowing that the earlier the retail exposure was those exposure which were less than 5 crore, but now it has been updated to 7.5 crore. So exposure which are less than 7.5 crore are classified as regulatory retail exposure, right? So this is a big number, right? So friends, let's start and begin our discussion. So friends, let me start with this question that every retail banker in this country might be having in mind, that this is a simple change. This 5 crore to 7.5 crore is a simple change, but and it unlocks a lot of capital for the banks. I may say billions of capital for Indian banks, right? So it sounds very wonderful, but here is the catch that nobody is talking about. So under this threshold, which will be now rated 75% for regulatory retail, you do not rate anymore. You do not apply 75% risk weight to your personal loan portfolio, right? So personal loan portfolio is out. It doesn't qualify. Okay. Again, similarly, your credit card revolvers are out of this scope. Okay. So I can say half of your retail portfolio that you have been happily parking at 75% risk weight for years. So under new draft guidelines, it is moving to around 125%, right? So friends, point here is this is not a small adjustment. If you do some maths, you will come out. I will explain this maths later. But for now, I can say that this increase is actually 67% increase in capital consumption. Okay, so for a suppose on a 50,000 crore book, we are talking about around 2,250 crore of additional capital. Okay, so 2,250 crore of additional capital we are talking about. And friends, this is the real money. This is the real money, and that's the difference between a good year and a capital raise. Okay, so now, why you should care for it? Why you should care? So friends, you must be knowing that India's retail credit market, which almost stands at, I can say 82 lakh crore. Okay, 82 lakh crore. This is 82 trillion actually. So I can say this is as on FY25. So that's a very big market. The entire retail credit market stands at 82 lakh crore as of financial year 25. And it has consistently growing at over 15% compounded since FY19, right? So the growth is exponential. Now, retail portfolio is actually the engine of Indian banking, and the draft standardized approach guidelines effective April 2027 are about to fundamentally redraw the rules of how we classify this book, right? So, friends, it is very important. This part of the portfolio is very important. So, with this background, I am now going to actually deep dive what actually changed and what are the criteria and given under the retail exposure, not just memorizing the risk weight percentage, right? Which is 75%, which you already know. Most of you which who are working in this Basel team or standardized approach team must be knowing regulatory retail exposures are risk weighted at 75%. But that's not the case. I'm going to discuss here. I'm going to discuss the practitioner insight. Okay. So for whatever time it will take, I'm going to make you understand regulatory retail exposures better than I can say 90% of the bankers in this country. Okay, so that's not a boast; it's a promise to you. And because I have spent much time in this credit risk, and what I'm about to share is the distilled wisdom of, I can say, 100 of hours of analysis, and also I will share you with some presentation also. Okay, so friends, whether you are a risk manager or a relationship banker, or you may be working as a compliance officer or a chartered accountant preparing for bank audits, so friends, stay with me, and this will be the most valuable minutes you spend this week, right? So let's go into it now. Okay, friends, before we deep dive into the rules, let's understand first the philosophy. What is the philosophy behind it? So why does the Basel Committee and by extension the Reserve Bank of India give retail a lower risk weight than corporate? Okay, just think about it. Okay, so you know the regulatory retail portfolio It carries a risk weight of 75%. Whereas corporates are rated, risk weighted much higher. Okay. So what's the analogy behind it? So analogy is simple. So this is a bank, and if working in a bank, I lend 100 crore, suppose 100 crore to one corporate. Okay, this is a corporate. So if you lend 100 crore to this one corporate, and this corporate actually defaults. Okay, so this corporate defaults. So what happens? I lose this 100 crore rupees entirely, right? But what happens if this bank lends to many retail borrowers? Okay, say 10 lakh each. Okay, and dot 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 10 lakh each. Okay, so in this case, your portfolio is diversified. So what happens? Even if the default rate is 5%, or in this case, for example, so I lose only how much? I lose only 5 crore of rupees, right? So rest of the portfolio absorbs the shock. Now this is actually what is called granularity adjustment. Granularity adjustment, right? So a well-diversified retail book has a natural insurance mechanism built in inside it, right? So the losses are more predictable, it's more stable, and it's more manageable also. Empirically, friends, we have also seen that the loss given default is lower in this case. Okay, so the correlation, if I talk between the individual retail defaults, is lower than between the corporates in the same industry. So this is not the theory. Actually, this is a decades of data from banking systems across the world, and that's what exactly Basel says. So Basel says, so if your retail portfolio meets certain quality thresholds, okay, so there are certain quality thresholds, we will discuss it further. So if your retail exposures meet these quality thresholds, so you can hold actually less capital against it. That is 75% risk weight instead of a 100% risk weight, right? So, but this is a critical, not all retail qualifies for it. Okay, so RBI doesn't just hand out 75% to every loan under 7.5 crore. Okay, so you have to actually, I can say you have to actually earn it, right? You have to actually earn it, right? So friends, now how you will earn it? So what are the criterias? Okay, so assume it or think it as a 4-log vault. Okay, so the first vault is this orientation criteria, right? First vault is orientation criteria. Second one is product criteria, right? And third one is low value of individual exposures. And the fourth one is granularity criteria. I will discuss this in detail. But for now, you think of regulatory retail as a 4-log vault. So what happens? You need all the 4 keys to open it, right? So if you miss even one and the vault says that your exposures gets actually thrown out to a higher risk weight bucket, right? Friends, let me give a check of this. I will give you a quick overview before we deep dive each one. Okay, so let's discuss about the log one, that is orientation, right? Log one is orientation. Now, what does orientation actually means? Orientation means who is your borrower. Okay, so only individuals, HUFs, or we can say qualifying MSMEs, these 3 only get in, right? Others are out. So first you have to check who is your borrower. Very important, right? Now, second criteria is your, I can say log 2, it is product criteria, right? So what does this criteria says? This criteria says, what did you actually lend, right? What did you actually lend? So in this criteria, only specific product types qualify, right? And the transactor definition here is a landmine. I will discuss it later, but for now, you can only note down this term, transactor, right? Now, third criteria is low value, right? Low value. What does this mean? This means that how much? So how much is the total exposure? So it must be within 7.5 crore, right? And this is aggregated across everything. Okay, I will discuss it later, but for now, you just note down this number, 7.5 crore, right? And the fourth one is about granularity adjustment. Okay, so this criteria actually says that does this one borrower make up too big a chunk of your portfolio? Okay, so no single exposure can exceed 0.2%, right? So this all 4 is required, and it is required simultaneously. So there are no exceptions, right? So from the practitioner point of view, if I can say that I have seen that banks lose crores in capital efficiency simply because they didn't classify the retail book correctly, right? So the difference between 75% and 125% isn't just a, I can not say just like it is a 50% points on the paper, right? So if you can imagine on a 50,000 crore book, that's 2,250 crore, which I discussed earlier also, of additional capital that is sitting idle, actually, right? So it is very much necessary that you classify your retail book correctly. and that capital which is sitting idle, that cannot be lent, that cannot earn a return and comes straight off your return on assets. So it straightforwardly impact your return on assets, right? So many of the top executives even don't no idea about this, what is happening inside. So this is on the operational level. So you have to classify your retail exposure correctly, and all the 4 criteria are simultaneously gates. So if one fail, it is fail all, right? This is important. Okay, friends, I think you got an overview. Now what we will do, we'll deep dive each criteria with real example, so it will help you in understanding what actually these criteria are, right? Okay, so we will discuss our first criteria, that is orientation, right? So this says who gets in, right? So looking at this criteria, this one seems very simple, but there is a trap in it, right? So what's the trap? The exposure must to be an individual, so any natural person, an HUF, or to a micro, small or medium enterprises, right? So it should be an individual, HUF, or MSME, right? But I will discuss here a trap. What's the trap? So for MSMEs, if your MSME borrower belongs to a group, right? So the consolidated group annual sales must not exceed 500 crore. 500 crore. Okay, not the individual entity, but the group, right? So let me give you a real scenario to better understand it, right? Consider a firm, ABC Traders, right? I've just taken an example, ABC Traders. Okay, so this firm is actually a small trading firm, and its annual turnover is you can say it's 80 crore, right? So this is a classic example of a MSME, right? Now there are part of a group where the consolidated sales are 400 crore, right? So these ABC traders are part of a bigger group. These are part of a bigger group whose consolidated sales is 400 crore, right? Now what happens? This company actually takes a loan of 4 crore. You can say CC limit of 4 crore, right? And it also takes a facility of term loan, which is you can say, for example, 3 crore, right? So just try to understand, friend. I'm discussing this MSME criteria. Okay, so I'm discussing the trap here. ABC Traders is a classic example of MSME, but it's a part of a bigger group, that is 400 crore whose sales is, and ABC Traders avails 2 facilities, 4 crore CC limit, 3 crore term loan, right? All good. Now this is also under 500 crore group exposures, and combining these two exposures, this is also less than 7.5 crore. No issue. This is classic example of regulatory retail. So friends, it will, there is no confusion here. It will straight up apply risk weight of 75%. Right? No issue. Now friends, issues come here. What's the issue? Let's fast forward it for 1 year, right? So the group, this group do very good business, and its sales increases very much. And let's fast forward it 1 year. So you can say that group acquires another business, and the group sales jumps to 600 crore. You must be having intuition what I'm trying to explain here. The group sales jumps to 600 crore. So friends, same company, same loans, right? But now what happens? This ABC trader is actually kicked off. It's kicked off of the regulatory retail portfolio. Why? Question here is why? Because it has failed this orientation criteria. This criteria is now failed. Why? Because the group entire exposure now crosses the 500 crore landmark, and hence this ABC trader is now no more a regulatory retail portfolio part. It becomes a corporate. So the loans which ABC traders were availing were now will have a corporate treatment, that is 100% risk weight for an unrated borrower, or whatever the external rating applies. Okay, so friends, what I'm trying to explain here is, this is very important. So think about how many MSMEs in your bank's books are close to that 500 crore group threshold, right? So they all can simply jump from 75% to 100%. I'm assuming 100 here, right? So this is the trap actually. Now friends, coming to other criteria, next criteria, that is lock number 2. Okay, so I have initially told you there are 4 locks and you have to pass all the 4 locks. So first one was orientation criteria. Second is the product criteria. Okay, so this is where the real complexity lives actually. Okay, so not all retail products qualify. So what all products qualifies here? If I can say revolving credits, lines of credits, like credit card, overdrafts. Okay, but there is a catch. It can be only transactors, right? Other products are term loan, leases, right? So these products actually qualify this product criteria, right? So friends, you must be wondering, what is this transactor? So if I go by the definition, a transactor is a borrower who has repaid the entire outstanding balance in full at every scheduled repayment date, right? For the previous 12 months. Okay, 12 months, not 11, not mostly, each and every single month. Okay, so it is a person, it is a borrower who has repaid the entire outstanding balance in full. So it has paid the bill full in every scheduled repayment day, every bill date. Okay, for the previous 12 months. So even if he has missed for 1 month, last 1 month, it will be out of the transactor. Okay, and for OD, overdraft facility, you sanctioned, it's even stricter. What it says to qualify as a transactor? It says that for overdraft, no drawdown should be over the previous 12 months. So OD you sanctioned, but the customer never used it. Okay, so that's a transactor. So that the moment they dip in, even once, the clock resets, right? So friends, let's understand it with an example that will be much clear to you. Suppose this is a man here, and his name is Mr. Sharma. Okay. Now, what does this Mr. Sharma do? This he is actually a salaried person. Okay, and he has taken actually an education loan of 5 crore rupees, right? And Mr. Sharma also avails a credit card with a limit of 2 lakh, right? And what does Mr. Sharma, since he's a salaried person, he pays the credit card bill full every month, like a clockwork. And let's take one more facility here. He also avails an OD limit. Okay, and this is supposed for 1 crore rupees, and he's never using it because he's having a handsome good salary. So just for contingency, he has kept it. So he's never using it. So that limit is totally untouched, actually, right? So what is its total exposure? Its total exposure is approximately 6 crore rupees. Okay. So you can friends see easily here that this 6 crore is well below that 7.5 crore threshold, right? All good. So what risk weight will be applied here? Risk weight will be applied 75%, right? Now what happens? So this is actually your, you can say, dream customer, right? But now take the same credit card customer who pays in full for 11 months. Take a similar customer. Okay, Mr. B. Now this customer pays the credit card bills every month like Mr. Sharma was doing, but only difference what he had done, he had paid full for 11 months, and just in December month, for example, just in December month, let's say he has done a lot of holiday shopping, and he carries forward a balance of 40,000 rupees, for example. Okay, so he carries forward this balance 40,000 rupees. Now this is a very small amount. Okay, just 40,000. But what happens to the bank? What happens to your exposure? That 1 month disqualifies them as a transactor, actually. So that credit card now attracts that credit card which you have given him. Now it no more attracts 75% risk weight, but it will now attract 125% risk weight. You see a big change. That one slip, 12 months of good behavior, all undone. Right. So this is just an example to understand how things changes by just a small change in the borrower behavior. Right. So if you try to understand the practitioner insight here, So what happens in real life, friends? A customer takes a credit card and uses it responsibly for 11 months. And what happens one day, it carries a balance in December for holiday shopping. And just like that, the classification changes from 75% to 125%, 125%. So what your bank needs to actually do here, your bank need to track this monthly, and the classification can flip back once they complete another 12 clean months, right? But for now, you have to risk weight it as 125%. It can go to transactor again if they complete another 12 clean months, but currently you have to risk weight 125%, right? So friends, this is also a burden on the system. Okay, so the burden is enormous. You have to track actually for correct applying the risk weight. So that's a very important point for those doing audit also in the banks, right? I think it is clear. Now we will move to our third segment, that is the aggregated threshold, right? That is low value, the third criteria. So friends, my third word was the low value criterion, right? So let's understand what this criteria says. This actually says the total exposure to any one counterparty. Okay, so the total exposure, and this total exposure means across all products, all branches, right? Fund-based, non-fund-based, or it can be off-balance sheet, everything. So must not exceed 7.5 crore, right? So now how do you measure this? Actually, the problem is how do you? So here is the rule that trips the people up. So what you take the sanction limit or the actual outstanding, whichever is higher, right? To measure the exposure, you can take either the sanction limit or the outstanding. So whichever is higher, right? So now the question is why we are taking like this. You must have a question in the mind why we are taking like this. So friends, this is because if you have a sanction limit, right? Say if you have a sanction limit of say 10 crore and only 5 crore is drawn out of it. So your risk is totally not 5 crore, it is 10 crore, right? So why? Because the borrower can draw the remaining 5 at any time, right? So there is one exception here for pure term loans and EMI based facility where there is I can say no redraw feature, meaning that money repaid cannot be borrowed again. So you use your actual outstanding only. Okay, so this makes sense. Like you can consider like a home loan borrower. So a home loan borrower where you have repaid 3 crore out of 5. So your outstanding is 2 crore only. Okay, and you can't reborrow that 3 crore, right? Okay, so that's why it is sanction limit and outstanding, whichever is higher, right? Now this total exposure which you are talking about should not exceed 7.5 crore, right? Earlier it was 5 crore limit, but now it has significantly increased by 50%, I can say, from the current from that 5 crore limit, and that's a significant increase. Okay, so many borrowers who were previously over the threshold are now inside it, right? And that's the capital unlock I was mentioning in the opening lecture, right? So this is your third criteria. I think it is clear. It's straightforward. Okay, this is granularity. Okay, the portfolio level card. So friends, this is only the criterion that operates at the entire portfolio level, and this doesn't operate at the individual level. Okay, so what this criteria says? This criteria says that no single counterparty's aggregated exposure can exceed 0.2% of the bank's overall regulatory retail portfolio, right? So that percentage is important, 0.2%. Okay, so friends, this is actually, you can say this is actually a 3-step process. The first step is you have to identify all exposures, right? That meets the first criteria, that is block 1, orientation criteria. Okay, now first you have identified these exposures. Now what you have to do, within that you have to identify a subset, okay, that meet the product criteria, block number 2, and the 7.5 crore threshold, that is the third criteria. Okay, now you have to do a check here. So this was the second step. Now third step is you have to check here. What you have to check? You have to check that does any single counterparty here, which you have filtered, exceeds that 0.2% threshold in the last quarter. Right. So you have to check that does any single counterparty exceed that 0.2% of that subset. Okay, this subset you have to check individually. Right. So friends, here is the kicker here. The RBI has mentioned that NPAs are excluded here. Okay, NPAs are excluded from the denominator. Okay, so what does this mean? So this means if your retail NPA increases, the portfolio, the denominator shrinks actually, right? So and when the denominator shrinks, each borrower's shares goes up, right? So you could have a counterparty that was comfortably below the 0.2% in the last quarter, and this quarter, because of NPA elsewhere in the book increased, they have reached the threshold, right? So without anything changing about that borrower, this things happen, right? So let me show for you. So it will be clear with this example. So friends, let's say that your bank has a 10,000 crore. Let's say your bank has a 10,000 crore regulatory retail portfolio, right? Now, one MSME has a total exposure of, say, so this is portfolio exposure. I'm talking about now one MSME. Say it has an exposure of 25 crore. Right. Now, we can calculate the ratio here. 25 divided by 10,000 crore. 25 crore divided by 10,000 crore. How much it comes? It comes to roughly 0.25%. Right. So friends, you can easily see that 0.25% is well above that our threshold. That is, it is above that 0.2%, which we were talking. Okay. So what happens? Even if it has, this MSME has qualified all the above three locks, because of this product granularity criteria, this MSME will now be kicked off the regulatory portfolio, even though it meets the orientation, product, and low value perspective. Right. So friends, you can see here this granularity is like this test is like a silent killer. Okay, so it's not about the borrower doing anything wrong. It's about relative portfolio composition, right? So I've seen where a single large NPA in the retail book pushed 3 other accounts into the granularity breach just because the denominator contracted, right? So if this because NPA is not included here, and if denominator comes is contracting, your ratio will increase, and if this will increase this threshold, it will be kicked off out of the granularity, regulatory retail. Okay, so what you should have actually, so you need to have a real-time MIS, okay, for this. So quarterly reporting is no more enough. You have to have a real-time MIS to monitor your regulatory retail portfolio. Okay. So what is the key takeaway here? The key takeaway here is that each log, I can say, has its own trap. Okay, so I've discussed above the group sales in the orientation criteria. Okay, that is a trap. In the second log, there is a transactor status trap. Okay, third one which I've discussed was about the total low value aggregated threshold point. That aggregation method itself is a trap. And the fourth one which I've discussed here is a NPA adjusted denominator trap. Right. So friends, each criteria you have to look very well and accordingly classify your exposures correctly. Right. Now moving to segment 3 of the circular. I have covered this 4 points: orientation criteria, product criteria, low value, and granularity criteria. Right. Now coming to this section. So there are certain exclusion list also. Okay. So this is actually the exclusion list. So what does this exclusion list actually mean? Okay. So this is actually where 90% of the banker catches here. So because now this is the section that frankly is the more important that we discussed about, that the qualifying criteria we discussed about. Why? Because this is where the banks bleed capital without realizing it. actually. So what happens, even if the exposure passes all the 4 locks, okay, your exposure passes all the 4 locks, but RBI says that these specific products actually are excluded from regulatory retail, right? So even if you passes all the locks, these exposures will not be classified as the regulatory retail, and they will go to a higher risk weight categories, actually, right? So let me walk you through each one, and more importantly, why, right? So first, coming to friends portfolio, which is personal loans. Okay, so personal loan, it is, it is a unsecured loan, and it is basically you can say consumption driven, and there is no end use restriction in this types of loan. Okay, so this is because the RBI views it very seriously, and the RBI views this as inherently higher risk. Okay, so there are no collateral also, and there are no asset creation also, right? So higher probability of default is there in this type of segments, especially in the stress scenario. Okay, so what RBI did, what the Basel did, so they carved out this personal loan out of the regulatory retail portfolio, and they directly sent it to section 19. We will discuss further at a 125% risk weight, right? So the only exception which they have given is on the education loan. This personal loan is sent out, but there is exception in this education loan, because if an education loan is there and it meets all the 4 criteria, it stays there in the regulatory retail. But if it is a personal loan, it is thrown out and it is dealt separately in section 19 of the circular. Okay, so education loan enjoys this 75% risk weight. So you can easily guess the logic here. The logic is very clear, friends. The education loan, actually education creates future earning capacity. Okay, a personal loan for a holiday to Bali, it doesn't create any value, right? So take an example. We can say say there is a person named Mr. Patel, and he has a personal loan of say 3 crore rupees, right? So he is an individual borrower. So orientation check is passed. Okay, 3 crore means it is under 7.5 crore. So that check is also passed. But since it is a personal loan, it is excluded, right? And this personal loan will attract a risk weight of 125%. So there is no further argument. Straightforward, it will apply 125%, not 75%. Right. Now coming to second exclusion. Second exclusion is credit card receivables. So we just discussed the friends, the transactor definition. Okay. So if the credit card holder is not a transactor, meaning they have carried a balance each one in once in the last 12 months, that I talked in the example of 40,000 rupees, which was carried forward in the December month. Okay. So likewise, you imagine a customer is there, and he has carried a balance even once in the last 12 months. So their credit card receivable is now excluded from the regulatory retail, because it is no more a transactor, right? It is no more a transactor. It goes to 125%, right? Think about it. What percentage of your bank credit card customers are truly transactors? You have to think about it. So in the most Indian banks, the number is somewhere between, I can say 30 to 40%, but that means 60 to 70% of your credit card book is sitting at a 125%. Okay. So that's actually the reality check you have to do. Right. Now coming to exclusion number 3. Exclusion number 3 is what? It is capital market exposures. So friends, any retail exposure linked to capital market activity. What are capital market activity? You can say loan against shares. This is a capital market activity, or you can say demat linked facilities. Okay. So these are excluded from the regulatory retail. Okay, why? The message is clear, because these are actually volatile and they have a correlated risk. Okay, so when the market fall, they fall together. There are no diversification benefit actually in this. Okay, so RBI says to apply 125% risk weight here also. Right? Now coming to fourth exclusion. RBI has excluded real estate exposures. Real estate exposure. Why? Real estate exposure means your home loan, your LAP, loan against property, okay, your commercial real estate. These all are comes under the real estate exposures, right? So friends, these all types of real estate exposures are carved out, and they are separately dealt under the section 16 of the guideline, which has its own LTV based risk weights framework. We will see, and risk weights there range from around, not it is flat, it is not flat, it ranges from 20% to around 150%, right, depending on the multiple factors. So don't worry, we will do a full deep dive on that in the next episode, and trust me, that is one of the even more complex things to understand, right, and actually to practically apply it, because it needs a lot of data. So we'll discuss that nuances there when we'll be dealing that section. But for now, you just note down that real estate exposure is not part of the regulatory retail portfolio, right? Now the last one is the loans to the bank's own staff, means staff loans. So here's the one that goes the other way. So you know, the friends, that loans to bank staff fully secured by superannuation benefits, right? Or they take housing loan, then the mortgage of their house is there. Okay, so these gets a preferential 20% risk weight under dealt under I think it is under section 21. Okay, so this gets a preferential rate. Okay, logic is very clear, because staff loans have the lowest risk in the book. Why? Because it makes sense, because you know where they work, you know their salary, and you actually hold their retirement benefits as security. Okay, so that's why it's the secure loan and there is the lowest risk. So accordingly, the risk weight is also lower here, right? So friends, you can see how this exclusions increase the risk weight drastically. Okay, so I will show you an example. So let's do some maths. Okay, so all theory is going on. So since I'm a quant guy, so I will explain you this with an example. Okay, now let's play with some numbers. Okay, so you will have a very clear clarity on how the capital is impacted. Okay, so you have a friends, say suppose 100 crore of exposure, right? So first we will see what happens at 75% risk weight. So at 75% risk weight, risk weight asset is 75% multiplied by 100 crore, that is 75 crore, right? So friends, you must be knowing this formula. You must have seen CRAR is equal to capital upon RWA. Okay, now let's assume the minimum capital only 9%. Okay, so at 9%, what happens? Capital into, sorry, CRAR into risk weight asset is equal to capital. Okay, this will be multiplied here. So your capital is actually 9% of your risk weight asset. Okay, so if we apply 75% risk weight, your risk weight assets comes out to 75, right? So what is 9% of 75? Okay, what is 9% of 75? It capital requirements comes out to approximately 6.75. Okay, so capital requirement is around 6.75. Okay, let's make it more simple. Let's suppose it is only 100 rupees exposure. Okay, so for 100 rupees exposure, you apply 75% risk weight. The risk weight assets comes out to 75 rupees, right? And your capital requirements comes out to 6 rupees and 75 paise, right? Now, it was the case when it was a regulatory retail portfolio. But what happens when it becomes a personal loan? It is kicked out of the regulatory retail portfolio, and now it will attract 125% risk weight. Now just see the impact. At a 125% risk weight asset is 125, right? So the capital requirement is 9% of 125, which becomes 11 rupees and 25 paise. See the drastic change here. 11 rupees and 25 paise. Okay, now this is in the case of 100 rupees. Now scale it up. So for a mid-sized bank, and suppose having a exposure of around say 15,000 crore personal loan book, right? So imagine what impact they must be getting. So they cannot apply this 75% risk weight here, because it is a personal loan portfolio, and they need to they need to apply 125%, right? So at 75%, they need, if they would have been applying 75%, then they need roughly around 1,012 crore of capital. 1,012 crore of capital. Okay, but at 125%, they need how much capital? They need 1,687 crore. This much capital they must keep in their books. Okay, so that's 675 crore of additional capital. If you find out the difference, it comes to 675 crore of additional capital. And friends, this is for one product. There can be many products like that. So this capital you need to keep extra. This is additional burden on your book. Okay. So this is actually a big figure. So if you show this insight, if you discuss it at the top level, you can show it that if for a portfolio having 15,000 crore of personal loan book would need roughly around 650 crore of additional capital. Okay, under the new norms compared to the current treatment. Okay, so that's the real money coming straight off the bottom line, right? And this was before we even got to the new non-transactor credit card impact, right? So friends, what's the key point I want to discuss here is, as a practitioner, I want to give you the insight here that most people miss actually. Okay, so the exclusion list which I was discussing is the more important than the inclusion criteria, right? So you can spend all day perfecting your 4 criteria classification engine, but if you have not properly identified and carved out personal loan, non-transactors, cards, and capital market exposures, so your entire regulatory retail calculation in that case is wrong, right? So my advice is start with exclusions always. Okay, so the key takeaway which I can say here is the exclusion list drives more capital impact than the qualification criteria, right? Now friends, moving to our last part of this video, and before I conclude this video, because we have done enough discussion, to just leave an impact on your mind to better to make your understanding more better, I will walk you through some real examples. Okay, and all right, so let's put everything together here, and I am going to walk you through the real banking scenarios, the kind you will encounter every day, right? So for each one we will classify. We will take examples, we will take scenarios, and for each one we will classify, we will assign the risk weights and calculate the capital impact. Right. So let's check scenario 1. There is one Mr. Sharma. Okay. And he has taken education loan of 5 crore, credit card limit of 50,000 rupees. Right. And he pays in full every month for 14 months straight. Right. And he has also availed an OD facility. This is education loan. And he has also availed a 1 crore OD facility, never drawn down. Okay, so what is his total exposure? Quickly, friends, quickly work out. What is his total aggregated exposure? Take your pen and pencil or whatever where you are working. Just solve this. So if you will solve this, you will have a better clarity. Is aggregated exposure. So use we have to use higher of the sanction limit and the outstanding. So education loan is a term loan with EMI. So we will use the outstanding here. Okay, so let's say the outstanding here is 4.8 crore. Okay, and credit card sanction limit is 50,000. OD sanction limit is 1 crore. Outstanding is 0 in OD, so there is no outstanding because he's not using his OD limit. So total approximately the exposure is 5.85 crore. So this is well under the 7.5 crore. So exposure criteria is met, and this was loan to Mr. Sharma. So the individual check, that orientation criteria, we have to check it. Product is education loan, that qualifies. The credit card, this criteria is clarified. The credit card, this is a transactor because he has paid full every month for the last 14 months. So that is also qualified. 12 clean months are there. Okay, check OD, there is no drawdown for the 12 months. Okay, so this criteria also fulfills, and it is a low value because the entire exposure is below 5.85 crore. So this is also qualified, and we assume that the granularity criteria is also fulfilled, and there is no breach. So what happens? This results in all three facilities will attract only 75% risk weight, right? So Mr. Sharma is what I call a capital efficient customer. Okay, so banks should be fighting for customers like this actually, right? Now suppose there is another customer, Mr. Y. Right. So Mr. Y is a individual borrower and he has a personal loan of 3 crore. Right. He has a personal loan of 3 crore and nothing else. Okay. So this is well under the threshold. So orientation criteria, individual, it is check is passed. Right. Product is personal loan. Stop. Here we have to stop. We have to put a full stop here because under section para point 14.3, this goes to section 19 with a risk weight of 125%. Right. Doesn't matter that it is under 7.5 crore. Doesn't matter that Mr. XY, whatever his name is, has a perfect credit score. Okay, personal loan is personal loan and 125% is applied. Clear? Now coming to scenario 3. Okay, So you remember that we ABC traders we discussed in our example. Okay, so let's play this out in detail. So ABC trader is an MSME with a 80 crore. ABC trader is an MSME. We're having a 80 crore turnover. Okay, so part of a group. This is a part of a group with a 400 crore consolidated sales. You must be remembering, right? Now they have a cash credit facility of 4 crore and a term loan of 3 crore. The total exposure was 7 crore. Okay, so let's pass one by one check. First orientation. It is an MSME and group sales is 400 crore. So it is less than 500 crore. So this check is passed, right? Now coming to the product criteria, CC facility and a term loan. So both are qualifying, CC facility and a term loan. So both these exposure are qualifying products. So this check is also passed, right? And the exposure is less than 7 crore because it has a CC limit of 4 crore and term loan of 3 crore. So 4 plus 3 is 7 crore. Okay, so it is well below the 7.5 crore threshold. So this low value criteria is also passed. And assume granularity criteria is, so let's take an example here to better understand. Let's assume that portfolio is 8,000 crore. Portfolio is 8,000 crore. Okay, so what happens? 7 crore divided by 8,000 crore, it comes to 0.088%, right? So it is under 2%, 0.2%. So this is also passed. So all the tests are passed. So both the facility, that term loan and that cash credit facility of 4 crore, term loan facility of 3 crore, this will attract a regulatory retail risk weight of 75%. Okay, now what happens 1 year later? Same group acquires a new business and the group sales grows to 600 crore. Okay, nothing else changed. Same loan, same amount, same performance, right? What happens? This fails the orientation criteria. Okay, because the group exposure should be less than group sales should be less than 500, right? So in this case, this entire loan will be classified to corporate, and if it is an unrated corporate, it will attract a risk weight of 100%. Okay, so that 25 percentage point jump on 7 crore of exposure remains same, but now it will attract 100% risk weight if we assume it is unrated. Okay, so there is a jump of from 75% to 100 crore, a jump of 25%. So that 25% risk weight on a 7 crore exposure means how much capital? Means around 63 lakh of more capital is required. Okay, now imagine multiply it across all MSME in a similar situation, and you are looking at a material impact here also, right? Now coming to fourth scenario, we will discuss. So this one is a beautiful in its simplicity. Okay, so I will take 2 credit card customers, right? Same bank, same card product, same limit of 2 crore. Okay, credit card customer, same bank, same card product, and limit is 2 crore. Customer A pays full every month for 12 months, and therefore it is a transactor, so it will apply a regulatory retail 75%. Customer B carries forward a balance of 30,000 in month 7, for example, and everything else is identical. But what is the difference here? He is not a transactor. He is a revolver. So he is excluded and he will apply 125%. Understood? So same product, same limit, same bank, 67% more capital on customer B. Okay. Now tell me, does your bank system distinguish this today in comments? Right. Now friends, take an example of a mixed portfolio to have a better criteria. Mixed portfolio. So say a person, Mr. A, has 3 loans: education loan, auto loan, and personal loan. Say education loan is around 4 crore, auto loan is 1.5 crore, and personal loan is say 2 crore. So total aggregated exposure is 7.5 crore. Right? It is actually at the threshold. Now here is what it gets interesting. You don't classify the customer. You classify each exposure separately. Right? You cannot say Mr. A belongs to regulatory retail. No. Mr. A's exposure belongs to which exposure? You classify on the basis of the exposure. Okay. So education loan is 4 crore. Right? Education loan is 4 crore. So it meets all 4 criteria. So we will apply here 75% risk weight. Auto loan is 1.5 crore. So auto loans are actually consumer credit. So consumer credit, friends, is not in the qualifying product list. I have not told this. Okay. So you will find that consumer credit are not in the qualifying product list for regulatory retail, and it goes actually in the section 19. So accordingly, it applies 100% risk weight. Right? Personal loan, as I already told, it is excluded under para 14.3. So it will apply 125% risk weight. So what happens? What you see here, it is interesting. Mr. A, single customer, 1 customer, 3 loans, and actually 3 different risk weights. So this is just a classification game in its full complexity, right? So what's the insight here? That Mr. A case is more common than you think. So most of the retail customers have multiple products with the same bank. Okay, so the classification has to happen at the exposure level, not at the customer level. So your system in the bank needs to tag each facility independently. So after tagging, it should apply the 4 criteria test, check for exclusions, and assign the correct result. Right? So all while monitoring the aggregate threshold at the customer level. You have to also monitor the aggregated threshold at customer level. Okay, so what I want to say here, that it is exposure level classification with customer level aggregation. So that's actually a what I call a dual challenge. Right? It is actually a dual challenge. Okay. Now next proceed to another example to have a better clarity. Now suppose we will discussing scenario 6. Now suppose there is a bank, XYZ bank, right? Now it has a regulatory trade portfolio of 10,000 crore, right? And there is an MSME, let's call it Delta Enterprises. Okay. So it has a total exposure of 25 crore. So everything else checks out, orientation, product, low value, right? But 25 crore divided by 10,000. This example I've also taken before also, but just for the sake of clarity, I'm describing it here. 25 divided by 10,000 crore is 0.25%. Okay, so that's above 0.2% ceiling, which we discussed in our granularity page, right? So what happens? This Delta Enterprises is reclassified out of the regulatory retail. Despite meeting 3 out of 4 criteria perfectly, it is reclassified. Okay, but now here's the twist. Here is the twist. What is the twist? Suppose next quarter the bank's portfolio goes to 15,000 crore. What happens? The bank's portfolio goes to 50,000 crore. Right? Now same 25 crore exposure will now be divided by 15,000 crore. Right? So what is the answer? It comes to 0.167%. Now it is below 0.2%. Okay, so in this case, next year, Delta Enterprises is back in the regulatory trade portfolio. Right? So what is my motive here? My motive is to make you understand that the classification is dynamic. Okay, and remember, NPAs are excluded from the denominator. So if retail NPAs spike, the denominator shrinks, right? And suddenly more accounts breach the granularity test. So it's like a cascading effect. So what is the key takeaway I want to say here? That classification is dynamic and it is at exposure level and it is all interconnected, not a one-time exercise, right? So in all these scenarios, this is my key takeaway, which I would like that you should keep in your mind, right? Now, friends, this was all in the regulatory retail segment, which I wanted to discuss with you to have a better clarity. But as I already promised you that let's get practical. You understand the rules, but implementing these rules across a bank with a 50 million retail customers, I can say 20,000 branches, 10,000 branches, 8,000 branches, and 15 different loan management systems. So that's where the real battle is. Okay, so we will quickly discuss, friend, what are the challenges because this has to be implemented from 1st April 2027. The first challenge that transactor tracking engine. So just I'm discussing it because when you will implementing it in real time in your bank, you must keep these challenges in your mind and how to tackle it. Okay, so I will give you just overview. The first challenge is that transactor tracking engine, which I discussed. So what you have to do, you need to actually track the 12 months rolling repayment history for every credit card, right? And every overdraft account also. So earlier what you were doing, you were just tracking that did they pay or did they not pay. But what you have to do here, did they pay the full outstanding balance by the due date? Every month, rolling basis, right? So what does this mean? This means your CBS, your core banking system, needs to talk to your card management system in real time, right? And you need a flag at the account level, right? Whether this customer is a transactor or this customer is a revolver, and that flag needs to be recalculated monthly, right? This is on the last 12 months. So a customer who was a transactor last month can become a revolver this month, understood? And vice versa. So after 12 clean months, right? So most Indian banks CBS platforms were not built for this, right? So you are looking at the middleware, data lakes, and potentially a dedicated microservice just for transactor classification. So this is the challenge number 1, right? Now coming to next challenge, challenge 2. Challenge 2 is regarding the aggregated exposure engine. So friends, I showed you that para 14.4 requires you to aggregate all exposures, right? Fund-based, non-fund-based, or balance sheet across all branches and products for every retail counterparty. And for MSME, you aggregate at the group level. Okay, so what does this mean? This means you need a single customer view, right? Real CKYC linked. You have to identify the group. Okay, cross product aggregation, everything. So what actually is situation that many banks still struggle with this. So a customer has a home loan in one branch, a credit card from another, and an OD from a third, and the system doesn't even know they are the same person because of multiple customer IDs, multiple CBS IDs of that customer. So this problem is very much sorted nowadays, but earlier it was a big problem. And then in that case, you need to compare the sanction limit versus outstanding and take the higher of the value. Okay, so for each product, for each customer in real time. So this, friends, this is actually not a year-end exercise. It should be done real time. Right? So this has to be looked upon. Third challenge I would like to mention here is about the granularity criteria. Okay, so you know, friends, 0.2%. So this test requires you to know the total size of your regulatory trade portfolio. Then only you can compare it. Then only you can put it in denominator. Okay, so you need to know the total size of your regulatory trade portfolio at all the times, and each counterparty share within it. Right? So with NPA excluded from the denominator. So what does this mean? So this means the denominator moves every time an account slips into NPA or gets upgraded. So the denominator keeps on changing. Right? So you need automated breach alerts. So if any counterparty crosses 0.2%, the system should trigger reclassification. Right? And you need to document this for the RBI's supervisory review. They will check it. Right? So this is another system level challenge. The fourth challenge I would like to mention here, that is product reclassification. Okay, so this is the biggest, I think, big strategic piece. Why? Because bank need to remap their entire retail book into two buckets. One is regulatory retail and one other is other retail. So every personal loan moves to 125%. Every non-transactor credit card moves to 125%. Vehicle loans move to 100%. Education loan stays at 75%. Okay, so this is not just a risk exercise. It feeds directly into pricing, right? So what I'm trying to explain here is, if personal loan now consumes 67% more capital, the cost of origination actually goes up. Okay, so the hurdle rate should goes up. So either the bank absorbs the margin hit or the customer pays more, right? Gold loans, which many banks classify loosely as retail, will move to 125% as personal loans after CRM adjustment, right? So microfinance not in the qualifying product rates, it goes to 100%. So all these things, there's a great migration, and there should be a product reclassification manual, right? So this is also a challenge. Now the last challenge which I want to discuss here is about the RBI supervisory review power, para 14.5. Okay, so finally the sword of Damocles, para 14.5, gives the RBI the power to evaluate whether 75% is appropriate for your bank based on your actual default experience, right? Very important. So if your retail asset quality deteriorates, if your retail gross NPAs spike, the RBI can assign a higher risk weight to your specific bank, right? Not the industry, your bank. Okay, so this is the supervisory discretion at its sharpest, I can say. Banks with poor retail asset quality cannot hide behind the standard 75%, right? So RBI is telling you to earn it, right? Either you earn it or either you lose it, right? So what's the insight here? Insight here is, from the practitioner point of view, I can say the technology upgrade alone for transactor tracking and granularity monitoring could cost a large bank 50 to I can say 100 crore rupees, right? I know running RFPs for these exact capabilities, everything. Okay, but here is the I can say thing: the capital saving from correct classification far outweigh this investment, right? So a bank that gets this right saves 100 of crores annually in capital. Okay, so bank that gets it wrong either overcapitalizes or wasting shareholders' money, or undercapitalizes and faces regulatory action also. Okay, so there is no middle ground. So friends, my key takeaway is implementation is a multi-crore technology and process transformation, and it is not a policy change on paper. Right. All right. So let's shift from what are the rules to what should you do about them, because the banks that move early on this will have a structural capital advantage for years to come. Okay. So I will tell you in briefly some strategies. Grow the 75% sweet spot. This is the first strategy. So what gets 75%? Education loans, MSME term loans, and working capital. So where group sales are under 500 crore. Okay, you grow your transactor credit cards, right? So these are your capital efficient products, and smart banks should be actively growing these segments, right? Education loans in particular are a gold mine from a regulator capital perspective. 75% risk rate only. Government interest subvention on some products, and a customer you acquire early who banks with you for decades, right? Secondly, the second strategy can be you have to reprice your personal loans. So personal loans at a 125% are no capital intensive. Okay, so the math is simple here. Your hurdle rate has to reflect the additional capital cost. And we are talking about 75% to 100 basis point of additional spread needed just to maintain the same return on the capital. Okay, so bank that don't reprice will actually destroy their shareholder value, and bank that reprice intelligently will maintain actually profitability while competitors will bleed, right? So you should incentivize your transactors. So if you work in the credit card business, so this is your action item actually. So your credit card strategy needs to pivot. So reward full payment, right? Cashback for transactors, lower interest rates for a full payment customers. Okay, you can do these things. Nudge customers away from revolving. Okay, why? Because every transactor saves you 4.5 rupees of capital per 100 exposures, I can say. Okay, so over a large card book, that's 100 of crores actually, right? In the similar manner, if you have a, I can say MSME borrowers near the 500 crore group sale thresholds, so you need early warning systems actually. So one acquisition, one good year of growth, and your borrower is declassified from 75% to 100% risk weight. Okay, so what you have to do, you have to track group sales quarterly and build alerts at 400 crore and have a plan for the capital impact if they cross actually, right? And the most important thing is real-time aggregation engines. So you need it. Transactor classification, microservices, granularity monitoring dashboards. You have to build up, and NPA adjusted and denominator calculations. So these are not nice to have. They are regulatory requirements actually, right? So what I can say here is the first mover advantage here is real. So April 2027 now seems far away, but if you factor in the time to build the systems, test it, you train your staff, run parallel calculations, and get internal audit comfortable, so you are already behind if you have not started. Okay, so the regulatory capital framework rewards preparation. The bank that implement early will optimize the capital, reprice your products, and reallocate balance sheets before the deadline. Okay, so these all things you have to see, and the ones that wait will scramble, actually overcapitalize and lose competitive grounds. Okay, so there is not a lot of time actually, right, friends? So friends, I've done a lot of discussion on this topic. So let me wrap up and let's bring it all together. So this lecture may be a bit long, but I've tried to make you this segment crystal clear, because this is actually about the 82 trillion portfolio which I was talking about. So this material is dense, and but if you remember, I will wrap it together. If just 5 things, you are ahead of most of the bankers, right? So 5 things to remember. First one is all 4 criteria must be met simultaneously: orientation, product, low value, granularity, everything. One miss and you are out. So, okay. So friends, remember that 4 log vault. I have told you this analogy will help you remember this thing. And you must also remember that you need every key for all the log vault, right? That is number 1. Number 2, the transactor versus revolver distinction, which I talked. This is the I will mention it. This is the single biggest P&L impactor in this entire section, right? So 1 month of carrying a balance changes your risk weight by 50 percentage points, right? So you have to track it monthly. You have to build systems for it. This is, I can say this is not optional. This is regulatory requirement. So you have to anyway do it, right? So coming to number 3, that 7.5 crore is a gift from the RBI, a 50% increase from the current 5 crore. So you have to use it wisely. You have to structure your retail exposures to stay within this threshold wherever possible. And every rupee above it falls out of the 75% bucket. You must be noting this point. Okay. Fourth, I can say number 4 is your exclusion list. So the exclusion list is very important, friend. Exclusion list is very important. And this is more important than the inclusion criteria, I can say. Okay. So friends, what I suggest that start your classification with what's excluded. That is personal loan, non-transactor cards, capital market exposures, real estate, staff loans. Okay, so get those right first, and the rest falls into place. And last but not the least, number 5, build your system now. April 2027 is closer than you think. The technology, the data, the infrastructure, MIS, all this takes 18 to 24 months to implement properly. So if you have not started your RFP, start it this quarter. Okay, or you can self-develop it under your bank, using your bank internal expertise. Right. So friends, now if you found this useful, and I hope you did. So friends, it's a request, hit that subscribe button, because in the next episode, we are diving into what I consider the most complex section of this entire circular, right? That is the real estate exposure, section number 16. Okay, so I will show you, friends, how a single home loan can attract risk weight ranging from 20% all the way to 150%, depending on the 6 different factors. That is LTV ratio, loan stage, borrower category, property type, and many more. Right. So it's actually a maze, and I'm going to walk you through every term. Right. Believe it will be a wonderful input for your working and understanding. Okay. So friends, until then, classify correctly, capitalize wisely, and stay ahead of the curve. Okay. So see you in the next one. Hit the like button and subscribe button, and thank you very much for staying till end.